Morning everybody, Simon Dixon here. In this video, I'd like to go over the different types of money and who actually benefits from their creation. The reason I'm doing this is I see so much confusion around how different forms of money are created, who benefits from it, and even debates at the highest level. I was watching a couple of debates this morning when people were talking about how governments have this form of currency and Bitcoin came along and created a private version, when in fact the money supply was privatized a long time ago in most countries around the world. So I just want to get in real simple, plain English for anyone to understand, an understanding of money. This is what made me obsessed when I studied economics years ago. Even the economic textbooks were giving incorrect assumptions about money. They were saying that banks are an intermediary between borrower and lender, which is a completely incorrect assumption. They were then teaching you things like multiplier effects based upon a base amount of currency, and then governments use interest rates in order to stimulate how much money is created. I just want to clear up all these things right now and just go through. So firstly, a couple of disclaimers. It will be different in different countries. I'm just giving you the general understanding that you need in order to understand the different forms of money and who benefits from its creation. The second thing is there are more forms of money, and there will be more. I'm just going through the most common one that help you give a better understanding when people are debating and understanding the debate. So let's just jump straight in with the first form of money. And the first form of money is money that is actually created by a government. Well, in fact, it's outsourced by the government, but controlled by the government to their central bank. And the central bank has, which is cash. It comes in two forms. It's either paper money or coins, and it's created by, in most countries, by a central mint, a royal mint. And that mint is the person that actually creates those coins and prints those notes. Now, the way that this is actually done is it's created by a royal mint or a central bank in order to meet the obligations of private banks, which are the creators of the next form of money, digital money. When you go to an ATM, an automated teller machine, and try to withdraw cash, banks want to keep enough cash in order to fulfill those obligations to prevent a bank run. So if you decide to turn your bank deposit into cash, then they need to ensure that they have enough cash in order to meet those obligations. It is a tiny fraction of money in the economy. In many economies, it's only about 3%, sometimes less, sometimes more, depending on the dependency of that country upon cash. But the way that it's actually created is it costs approximately, let's take a $10 note. It costs approximately 3 cents in order to print that note with the economies of scales at the Federal Reserve and the mint they use in order to print them. And if it's a $10 note, there's approximately $9.97 in margin. Now that $9.97 is profit that is added to tax revenue, and it's called seigniorage. Seigniorage is the amount of money that the government makes as a result of printing cash and coins, or minting cash and coins. And so it's a profitable activity, and it reduces the liability for taxpayers, reduces the government debt, and is transferred from the central bank to Treasury and appears on the Treasury balance sheet. So the more cash in an economy, in theory, that government-created money, which reduces the amount of tax one should have to pay if the government is actually balancing their books and trying to do that. Obviously, they don't do that, but seigniorage income is something that the Treasury, the government, benefit from, and it is actually the only form of money that they actually create, with the exception of some other new forms we'll go through. So, cash, notes, coins, they are government-created money, and taxpayer reduces the amount of tax one has to pay based upon seigniorage income, and therefore you would imagine that the people benefit from that or the government benefit from that, depending on your philosophy and ideology about whether your government is serving you or not. The next form of money is bank deposits. So the funny thing is everyone talks about the government printing too much money. At the highest level, we're talking about, world-renowned economists talking about this. But the reality is that the vast amount of money in the world is created by the private banking sector, and money is actually privatized. People talk about Bitcoin being a way of, a private form of money that competes. It does compete, but we already have private money. It's called bank deposits. So if you log into your online banking right now and you see a positive balance, it's because somebody else has a negative balance. Because for every positive balance, somebody else has to go into debt. So the way that it actually works is that when you go to a bank and you borrow some money, a banking license gives the bank the ability to create money every time they issue a loan. And the way they do this is through double accounting on the bank's balance sheet. When they issue a new loan, it is both an asset and a liability to the bank, and it is added to their balance sheet on both sides so that they match up. The reason that they consider it an asset is because if they issue you a loan, they get interest from that, and that is the profitable activity at a bank. The reason it's a liability is because when they add that deposit to your account, that is money that was created out of thin air that you have a right to claim upon, and you could draw cash upon it or you could spend it. And so a bank will create an asset and a liability simultaneously every time they issue a loan. Now, while you don't need to understand the accounting, all you need to know is that when a bank issues a loan to you, it's not somebody else's savings. It's not money that they had. It is essentially brand new money that they create. And what they do is they type it in the computer. It appears as a digital representation of the government's currency in your account, and you can spend it and use it as debt. Now remember, the governments, they create cash and coins, but they outsourced digital currency. So banks were the inventors of digital currency. When they managed to persuade lawmakers after many early bank runs, that they should be allowed legally in order to create more deposits than actually exist based upon debt. And so that is the process of that. Now, when you take out a loan, the money supply in the economy increases because it's brand new money. The beneficiary to that is the bank, because they actually get to charge interest on that money. When you repay that loan, the money supply contracts. Now, in most economies, about 97% of the entire money supply is created digitally by a bank, and therefore most money in the world is already privatized. However, crony capitalism means that you have to have a banking license in order to engage in that process, and the governments of the world have outsourced the creation of that digital currency to the private banking sector. If you live in the United States, then it's essentially a digital version of the US dollar. If you live in in England or wherever, it's a digital version of the Great British Pound. It's a digital representation of the money that the government creates. But it's not actually created by the government. Now, central banks around the world try to influence how much debt how many loans banks create through different tools, through monetary policy, through incentives to try and encourage people to move into home ownership, which is the largest tool for creating digital representations and bank deposits of your government's currency, is the mortgage markets, the real estate markets, the property markets, because banks have decided that it's the safest yet most profitable form of creating debt. And therefore, if you can't repay it, they can repossess the property or real estate can't run away. And therefore, almost 40% of all digital money is backed by the mortgage markets in many systems. So the point to understand, the takeaway, is that if you log into your online banking and you have a positive balance, somebody else has to have a negative balance for that positive balance to exist, because governments have outsourced money creation, the digital currency of the fiat currency of that government, to the private banking sector, and therefore all money is backed by debt in the digital currency system. And this is why it's really, really funny that many people in government don't realize that, and it's a big problem. The third form of money, so just to recap, you've got cash and coins created by the government, and the government, it's used as a seigniorage income to reduce taxpayers' burden. Bank deposits is a digital currency which is a representation of the government currency that's created by the private banking sector, and the private bank benefits from those interest rates, the interest that they can charge on that money that they create. But as you issue more loans, the money supply increases. As they are paid down, they disappear, and the asset and liability go off the bank's balance sheet. The third form of money is quantitative easing. So quantitative easing is a new form of money that was invented in Japan by the Japanese central bank that later was used very famously after the last financial crisis, which is essentially where the central bank engages in money creation by creating money that then can be used in order to issue loans to both the banking sector, large corporations, through the debt capital markets, through bond markets, products where you essentially were created in order to lend money to governments or lend money to large corporations. They are created at the central bank. And this is a way of flooding money into the economy at times of extreme events like the financial crisis, or a new tool that governments have used in order to actually try and, or central banks have used in order to try and exercise more control, because they outsourced money creation to the private banking sector. Now, quantitative easing is a fairly new tool, and is being used a lot right now, and the central bank's balance sheets have gone completely out of control as a result of quantitative easing in order to prop up the economy a little bit longer. The next one that's worth talking is what's called a reference currency. A reference currency, or a reference product, is where it is one form of money that represents another form of money. An example of this is a stable coin or PayPal or something like that. It's essentially a new digital ledger created by a private company or anyone really that could create a reference currency, with a promise that it is backed by the fiat currency, either the digital version or the cash version. You haven't seen many cash versions. But essentially a modern example in digital currency lingo is something like a stable coin, and it operates similar to something like PayPal, where PayPal promised for every dollar that you have in PayPal, there is a dollar at a bank, at PayPal's bank. The challenge with reference currencies is that over time, the actual reference, for whatever reason, tends to be moved away for something. So a very famous example recently is the most liquid stable coin is Tether. Now, Tether got itself in a situation where one of the financial institutions that was holding some of the dollars that it refers to actually allegedly had nefarious activities with it, and therefore a government seized some of those dollars. And therefore, while the Tether is backed by those dollars, some of those are held and inaccessible by government institutions which have seized those Tethers. And so therefore Bitfinex needed to find, or Tether needed to find another way. They're both the same, different companies but owned by the same parent. They had to find a way of actually bringing back that reference. But over time, reference currencies have always had challenges keeping the reference, and there's always some kind of incentive to engage in the banking model. So this is essentially a form of, the banking model is what's commonly known as fractional reserve banking, which is where you take a little bit of that deposit and you expand it beyond the money in existence. Fractional reserve banking is actually very misleading because there's ways of getting around the reserve, and many of the banks actually get around those reserves, and there's ways of getting around the fraction. So fractional reserve doesn't actually exist in many economies because sometimes there is no reserve and there is no fraction, because the reserve might be another form of money like bond markets, which were created as debt in the first place. So you've got debt being that reserve of the debt. So therefore it's not really a sufficient reserve because you can reserve it by assets. And the fraction can actually be loopholed by using regulatory arbitrage between what a retail bank can do, what an investment bank can do, and what a fund manager can do. And that was what we saw during the last financial crisis. In the last financial crisis, we saw retail banks saying that they were operating off a fractional reserve system, and therefore they were being regulated under that. However, they took a lot of their mortgages and they sold them on to an investment bank, or an investment bank packaged them up, whereby you could take all these individual mortgages, put them into one financial product, and then you could then sell them to somebody else as a packaged product. This is what was known as asset-backed securities, mortgage-backed securities, and all these different terms that came out of the financial crisis. You then took the investment bank, then took them, and they sliced them up into different pieces so that they could sell them to fund managers and pensions. And then they created other products where derivatives were created, where there was a reference to the underlying mortgage product, which was a slice of somebody else, of a load of mortgages, which was packaged up from the retail bank in terms of a tiny individual mortgages. And then you really didn't know who actually was. And then what they did is they created another innovation where they sold insurance, but they turned the insurance into a security whereby it could be traded, and people could buy and sell that insurance. And Lehman Brothers was one of the largest insurance of all these products. And so there was an issue where all the systemic risk of that entire system, when people didn't know, because the retail bank was just issuing as many mortgages as possible, the investment bank was packaging them up in order to get around fractional reserve requirements, and then they were selling them to your pension, and therefore the person that was issuing the loan no longer cared if it was repaid, because it was essentially sold on to your pension. And so you had the liability without actually knowing about it. And then hedge fund managers were coming along and speculating on these products. And then you had just a speculative frenzy around this. And that's how, you get around fractional reserve banking, by playing what an investment bank can do, what a retail bank can do. Anyway, slight tangent, but I thought it would be useful. So stablecoins is a movement towards full reserve banking. It's a reference currency, and it promises that everything is backed by whatever it says it's backed by. So if you have a stable coin backed by dollars, then it's backed by dollars, and it's that within that particular system is full reserve, which is a movement towards more of an asset-based economy or asset-based form of money. However, whatever is backing it up might be fractional reserve. So you could have a bank created the money, the digital representation, and then a stable coin is reference to that digital representation. So it's a bit of a pony game, but it's a movement towards full reserve banking. And the final couple of forms of money that I wanted to discuss was obviously Bitcoin. And I put Bitcoin in its own category because it does have its own monetary policy. It is very distinct from all other cryptocurrencies. And most other things that you see. If you go to a website like CoinMarketCap, you'll see 2,500 different cryptocurrencies, but some of them are tokens, which are more like stocks and shares, and others are just completely different use cases and things. Really, when it comes to actual sound money, then Bitcoin BTC is really the only game in town. And the reason for that is because of what we saw the last couple of weeks with Facebook. So when a centralized institution or company creates their new form of money, And if you have real traction like Facebook has, where you have 2 billion users, you get every form of government, every form of monetary policy, every form of everything turn up, and you get a Facebook hearing where you've got to explain every part of everything that you're doing. And eventually, if the government doesn't like what Facebook is doing, then they just can write it into law, shut it down, get rid of it, do what they want to do, co-opt it, get a backdoor. I think that in the end, they're going to co-opt and go for the data of having a world currency that might be able to achieve greater, a different thing to the dollar. But essentially, the reason that Bitcoin is different is because there is no CEO that you can put into a hearing. There is no identifiable creator. And it was created at a time when nobody cared, in a very decentralized way, when it was never priced. So people weren't speculating on it. The foundation of Bitcoin was when it was actually a genuine form of peer-to-peer electronic cash, where nobody was really going to benefit from it. And it was later that it became valuable and had trading and all these other types of things. But at that point, the creator of Bitcoin had left the project, and is now an open source technology that is powered by the largest supercomputer in the world. Now, the important thing about Bitcoin is that the people that benefit from it, from its creation, are what are known as miners. And the way that Bitcoin works is there's only ever going to be 21 million of them. That money supply can never change unless over 50% of operators in the network decide that it's going to change, which nobody will do, and therefore it's a scarce digital peer-to-peer electronic cash system. The way that it actually comes into existence is that it has a set release policy. So every 4 years, the number of Bitcoins that get created, it decreases by a set amount. So it started with every 10 minutes, 50 Bitcoins were created, and they were awarded to the miners. The miners are people that verify all the transactions by running automated computers, hardware, and algorithms. And essentially, they verify every single transaction. And they're given newly created Bitcoins every 10 minutes, and they're distributed amongst the miners through the system of pooling. And so it costs a lot to run these computers, and so it encourages longer term holding, because while you might have to sell some of those Bitcoins in order to cover the cost of your electricity, it's a very efficient market that adjusts to market demands for Bitcoin and how many people want to mine. And the more and more people mining, the more difficult it gets. So it mimics some of the properties of gold, but has a much more measurable fixed supply to it, and is more scarce. So the way that it works, as I said, 50 Bitcoins were given to miners every 10 minutes, and that goes on for 4 years. And every 4 years, the number of Bitcoins given to miners every 10 minutes halves. So originally it was, the first 4 years, it was 50 Bitcoins every 10 minutes being distributed to miners. The second 4 years, from year 4 to year 8, it was 25 Bitcoins issued to miners every single 10 minutes, and then it moved to 12 and a half, and then the next halvening coming up in 2020 as well, it moves to 6.25, until eventually the number gets smaller and smaller and smaller, and all 21 million Bitcoins are created. It's worth noting that approximately 17 million of them have already been created, and estimates state that anywhere between 4 and 6 million of them have just disappeared and been lost, because it is a bearer asset, and if you lose access to them, they just disappear. So the more people lose them, the more scarce it gets, in a very ruthless, brutal system of you owning your own money and taking responsibility of securing your own money, because it's not held at a bank, and therefore the bank can't create new money based upon that. And it's a different form of money and a completely new money supply. It provides an exit from the traditional financial system. So you can see cash and coins, digital currency created through deposits, quantitative easing are all done by one currency in different forms based upon the government's currency. which is either the US dollar or the pound or wherever you are, or the euro. And so these are the different, so then you have, that was Bitcoin anyway. So Bitcoin is a completely independent form of money with a fixed supply. And in my perspective, our world's best shot at ever achieving sound money. And then worth mentioning is obviously in comparison is Facebook. So Facebook's Libra is obviously going to be a reference currency. They've stated that it's going to refer to a basket of assets. I think in the case of the US, it's going to be US dollar. We don't know the full details yet, but it's really producing an interesting contrast to Bitcoin of what happens when you try to do something like what Bitcoin created, but via a centralized company, and therefore you have to, bow down to the system and be at the mercy of the powers that be. And so really it's shown in stark contrast of why it's important for Bitcoin to be decentralized and why it's so different from other cryptocurrencies where a person has come along, or a group of people or a company has come along and tried to create their own version of Bitcoin, and then everybody falls to that leader. And everybody's looking at that leader in order to push the currency forward, and you end up with a version of what happens with Facebook, where Facebook, essentially what they're doing is they're doing a hybrid model where they're trying to get 100 of the largest companies in the world, like Visa, MasterCard, PayPal, to act as what is known as node operators, where they verify all of the different transactions and receive the reward from the newly created Libra currency in a syndicate of these companies. The challenge is that these 100 companies, initially there's probably 20 to 30, they have an incentive once they own the monetary system to actually either change the reference, to vote on that as a syndicate, and then those 100 node operators can actually decide that they might want to engage in fractional reserve, apply for a banking license, and as it's such a profitable activity, that can change the money supply significantly in terms of that new form of money. And therefore, you're at the mercy of what these companies decide to do. And Visa, MasterCard, PayPal, are all people that have engaged in creating reference currencies. And then you've got other companies that might want to engage in that. So it's very different to Bitcoin. But let's just recap very quickly and close this video. So the first form of money that I covered is cash and coins. Cash and coins are created by the government via their central bank and mint. When they create it, they sell it to a retail bank. It may cost 3 cents to create a $10 note. There's $9.97 once they've sold it to the retail bank for their ATM, and that is added and transferred to Treasury and reduces the amount of tax revenue a country has to pay. Then you have bank deposits. Bank deposits are issued every time a bank issues a loan. They're 100% backed by debt. It is a digital representation of the government's fiat currency, and it is created by a private banking sector. The private bank receives interest on that money, and therefore they benefit from the creation of that money. Quantitative easing is money created at a central bank using debt-based products. And the beneficiary to that tends to be the recipients of that product that gets an artificially low interest rate on a large loan backed by the country's central bank, which is essentially, as long as the system exists, as good as credit rating as it can get. They do that in order to push money into the economy. Then you have Bitcoin, stable coins. Stable coins are reference currencies. They're backed one-to-one by the government-created currency or the digital representation of the government's created currencies. And once you have that stable coin, then you can either earn interest on it, or you can do things with it, or you can create a business model around that, and the issuer is the beneficiary. JP Morgan's looking to create their own stable coin, and many other people are doing it. Central banks are going to create their stable coins, I believe, to bail out the financial system. See some of my other videos. And then you've got Bitcoin, and Bitcoin is an independent money supply. Is backed by maths and code. It cannot be changed. It's scarce, digital, and it's apolitical. and is not affiliated with any company's or country's agenda, and is sufficiently decentralized, wherefore I believe it's our world's best shot at achieving sound money that I believe will eventually be purchased by central banks and added to a basket of reserves, and potentially could become one of the assets as a world reserve currency as well. And then you've got things like Facebook, which is a hybrid model where a bunch of companies and centralized organizations all organize themselves around being the validators, like similar to Bitcoin, but rather than decentralized, a group of permissioned companies that are able to do that. And they create a reference currency, and then the node operators can dictate the vision moving forward. So I hope that was useful for you. It's a really, really tricky topic. One of the big problems in financial technology is finance is completely jargon rich, different jargon for different countries, confusing as hell. Technology is completely jargon rich, different standards exist in different things. Create finance technology and you've got a jargon hell a nightmare. And my goal is to try and navigate you through in these tweets and give you content so that you can make better informed decisions about where to actually place trust and where to put your money. Not financial advice, you have to do your own research. I just want to give you more information to be able to decide what you're going to do. And check out my other videos if you want more content on how the financial crisis is going to play out, whether it's what Facebook cryptocurrency is doing, how the financial crisis, what are the systemic risk events, which countries are positioning themselves to be the next world leaders, what's going to happen to the US dollar. I'll keep providing commentary as this all unfolds. Remember to retweet this, like this. If you think others can benefit from this, please help me in sharing this content. I'll also repost this on YouTube. If you're watching it on YouTube, subscribe over there. My YouTube channel is called Simon Dixon. If you hit the subscribe button, there's a bell symbol next to it, and YouTube will send you an email every time I create a video just like this. And really want as many people as possible to be understanding money, because I think that we're about to engage in one of the largest wealth divides, wealth reallocations that we've seen in financial history between those on the right side and those on the wrong side. And you're going to have to make your decisions and speculate upon that. And if you don't speculate upon that yourself, then someone else is going to be doing the speculation for you, and you're at the mercy of whoever you are holding your money with, because they're the ones speculating for you. So I'm going to go back to work, and thank you for your time.